You have just witnessed a sharp and highly questionable drop in silver prices in the market. What stands out is not only the magnitude of the decline, but the manner in which it occurred: fast, decisive, and without any clear accompanying fundamental change. This event highlights an important reality. The mechanism shaping silver prices at the present time contains points of instability that warrant close attention. When prices can reverse sharply within a matter of hours without any macroeconomic news, without new monetary policy decisions, and without any evident supply-demand shock, the issue no longer lies in investor sentiment, but in the operational structure of the market itself. This year is 2026. But looking back at history, this is not the first time the silver market has exhibited such behavior. Similar scenarios occurred in 1980 and again in 2011. Both periods shared common characteristics. Silver prices surged, broke through key psychological levels, and then abruptly reversed over a short period. Not because physical demand disappeared, but because technical trading mechanisms were triggered. For that reason, the question that needs to be asked now is not whether silver will rise or fall over the next few sessions. The more important question is this: does the recent movement fit the statistical profile of a normal market correction, or are we witnessing a mechanical intervention aimed at rebalancing the system? A healthy market can experience sharp volatility, but it rarely does so in an informational silence. When price movements exceed historical norms while the fundamental backdrop remains largely unchanged, analysts cannot stop at the price chart alone. We are compelled to look deeper into the price formation process, operating rules, and the tools used to manage risk within the system. This analysis approaches the recent event in precisely that spirit. It is not intended to forecast short-term silver prices, nor to draw emotional conclusions, but rather to address a core question. Is the current silver price reflecting genuine market supply and demand, or is it being dominated by technical mechanisms that can distort the price discovery process? If you are interested in analyses that go straight to market structure, monetary mechanisms, and publicly available data, rather than focusing solely on short-term price movements, please subscribe to the channel, enable notifications, and follow the upcoming segments. We will methodically peel back each layer of data to understand what is truly happening behind the movements in the silver market. Before discussing causes, it is necessary to clearly define the phenomenon. Within just a few trading hours, silver prices fell with a magnitude and speed rarely seen in normal trading history. The issue is not how much the price fell, but how quickly it fell, and under what conditions. When this movement is placed within a statistical framework, it far exceeds the average intraday volatility of silver over many recent years. Natural corrections typically unfold through time dispersion. Selling pressure builds gradually, liquidity absorbs it layer by layer, and the market has time to respond. Here, the opposite occurred. Selling pressure appeared simultaneously, continuously, and gave the market no opportunity to self-balance. More importantly, during that period, there was no corresponding fundamental catalyst. There were no unexpected economic data releases, no changes in monetary policy, no new geopolitical shocks, nor any information indicating a sudden weakening in industrial demand for silver. When prices move sharply while the informational backdrop remains static, analysts must acknowledge one thing: the momentum does not come from new market expectations, but from an internally triggered mechanism. In professional market analysis, this is a classic sign of a forced liquidity event. Such events do not require investors to change their minds. They require only a sufficient condition to force positions to close, regardless of prior views or forecasts. Once that condition is triggered, price behavior becomes steep, synchronized, and lacking counter-movement, exactly as the silver market has just displayed. Another noteworthy aspect is the time structure of the decline. The concentration of volatility within a narrow time window indicates that selling did not arise from a natural distribution process between buyers and sellers, but from a chain of forced liquidations. When one layer of positions is compelled to close, it exerts price pressure that pushes the next layer toward its risk threshold, thereby triggering the next wave of selling. This is a characteristic of leveraged markets, not of a purely spot market. Therefore, at this point, we can provisionally draw a methodological conclusion. The recent price movement requires a mechanical explanation, not a psychological one. The market did not panic in response to new information. It reacted to a change in operating conditions. The next question, and the core focus of the subsequent analysis, is which mechanism within the structure of the silver market is capable of generating a forced liquidity event of such scale and speed? To answer that, we must go directly to the factor that most directly influences price behavior in derivatives markets: margin and leverage. To understand why a price decline can occur so quickly and steeply, it is necessary to look squarely at the leverage mechanism of the derivatives market, where the majority of silver trading volume is currently conducted. In this market, prices reflect not only supply and demand, but also the margin tolerance of open positions. By design, futures trading allows investors to control a large quantity of silver with only a small fraction of its notional value through margin. This mechanism increases liquidity and capital efficiency, but it simultaneously creates a structural vulnerability. When margin requirements change, price behavior can change instantly. A margin hike, an increase in margin requirements, is not, in itself, unusual. Exchanges have the authority to adjust margin levels to manage systemic risk. However, the impact of a margin hike depends entirely on timing and context. When markets are stable, higher margins simply reduce leverage in an orderly manner. But when markets are already under strain, prices rising rapidly, large short positions, and liquidity skewed to one side, a margin hike becomes a trigger for forced liquidation. The critical point lies here. A margin hike does not require investors to change their views. It only requires them to post additional capital. If they cannot do so immediately, the only option is to close positions. When this happens simultaneously across the market, it no longer operates according to decision-making logic, but according to account survival logic. Prices then move not because sellers believe prices should fall, but because they are forced to sell to remain within the system. In the context of silver having just experienced a sharp rally, a margin hike functions like tightening leverage in the middle of a crowded trade. Highly leveraged long positions immediately become points of weakness. One layer of positions being forced to liquidate pushes prices lower, causing the next layer to breach risk thresholds, thereby triggering a cascading spiral of selling. This is not spontaneous market behavior. It is the mechanical response of a leveraged system. It is important to emphasize that, in this context, a margin hike does not reduce overall risk. It merely transfers risk from the system's balance sheet to the accounts of participants. Risk does not disappear, it is released through price. And when risk is released in this manner, volatility becomes steep, unidirectional, and difficult to control. From a monetary analysis perspective, this marks a crucial distinction between a market correction and a liquidity event. A correction occurs when expectations change. A liquidity event occurs when participation conditions change. The recent drop in silver prices bears all the hallmarks of the latter scenario. And once the triggering mechanism has been identified, the next question becomes unavoidable. Which groups face the greatest risk if silver prices continue to rise, and therefore have the strongest incentive for the system to rebalance? When a liquidity event occurs, the important question is not who is selling, but who cannot withstand prices continuing to move higher. In derivatives markets, this question is answered by position data, not by sentiment. The standard tool for examining that structure is the Commitments of Traders (COT) report published by the Commodity Futures Trading Commission. This report classifies market participants by economic function: commercials, primarily banks, market makers, and hedging businesses; non-commercials, funds and speculators; and retail. The key focus lies with the commercials group. Over many periods, this group typically maintains a significant net short position in silver. That does not automatically imply being wrong, because commercials may be hedging physical operations. However, when the size of the net short position swells in an environment of rapidly rising prices, systemic risk begins to form. Put simply, every additional $1 increase in silver prices translates into a corresponding notional loss equal to the total number of ounces sold short. When that figure reaches hundreds of millions of ounces, the pressure is no longer transactional. It becomes balance sheet pressure. At that point, the issue is no longer about whether a price forecast is right or wrong, but about the system's ability to absorb temporary losses. This is a point many retail investors tend to overlook. Markets do not collapse because someone wants to suppress prices. Markets rebalance themselves when one side accumulates risk beyond its tolerance threshold. When prices move beyond what a large group can endure, the system activates mechanisms designed to slow or reverse that movement. Margin hikes are one such mechanism. From a structural analysis perspective, sharp price increases in the presence of large net short positions are not just a story about profits for buyers, but about survival for sellers. And when survival is threatened, markets do not wait for expectations to adjust. They respond using the risk management tools already in place. This helps explain why technically driven interventions often appear not when markets are weak, but when markets are rising and exerting pressure on a specific side. This is not a new phenomenon. History has repeatedly shown that when position structures become unbalanced, price behavior will reflect efforts to restore that balance. Therefore, Part 4 does not seek to assign motives, but to clarify the risk context. By understanding who bears the greatest risk if prices continue to rise, we can understand why the system reacts so strongly and so quickly. And to determine whether the recent event is an isolated occurrence or a reflection of a structural pattern, we must look back at historical precedents, instances in which the same mechanism was triggered under very similar conditions. To assess whether the recent event is idiosyncratic or indicative of a broader structural model, there is no better approach than placing it within a historical context. The silver market has experienced moments in the past where price behavior closely resembled what we are witnessing today, not only in terms of volatility, but in how the system responds when upward momentum becomes difficult to control. The first case is 1980. At that time, silver prices rose at an extremely rapid pace, breaking through every familiar psychological threshold. Instead of allowing the market to self-adjust through supply and demand, the trading system changed the rules. New long positions were restricted, trading conditions were tightened, and the price formation process was disrupted. The result was not a gradual correction, but an abrupt reversal that brought the entire bull cycle to an end in a very short period of time. 3 decades later, in 2011, a similar scenario unfolded in a more modern form. As silver approached its historical highs, the exchange repeatedly raised margin requirements multiple times within just a few trading days. These actions did not stem from changes in physical supply and demand, but from the need to control systemic risk in an environment of elevated leverage. The consequence was a sharp collapse in silver prices over the following weeks, despite investment and industrial demand remaining strong at the time. What these two periods share is not a specific price level, but the timing of intervention. Technical measures were not deployed when the market was weak, but when prices were rising fast enough to exert pressure on position structures and the balance sheets of a major side within the system. In other words, intervention appeared when the price discovery process began to move beyond the system's zone of tolerance. This leads to a methodological conclusion. History does not prove intent, but it does reveal a clear asymmetry in market control. When prices fall, markets are allowed to operate freely. When prices rise too quickly, risk management tools are activated to reshape the movement. Placing the events of 2026 into this sequence, we no longer see an isolated price drop, but the repetition of a behavioral pattern. That pattern shows that the silver market, especially the derivatives market, responds not only to supply and demand, but also to the tolerance limits of the financial system that stands behind it. For this reason, the critical question is not whether this time resembles 1980 or 2011, but rather, are the structural conditions that led to past interventions re-emerging today? To answer that, we must step away from price charts and examine the ultimate determinant of any commodity market: delivery capability and the amount of metal that actually exists within the system. If the previous sections helped identify the mechanisms that allow prices to fall rapidly, this section addresses a more fundamental question. Does the system truly have enough silver to meet its delivery obligations? Because in every commodity market, the final arbiter of all price debates lies in the ability to deliver physical material. In the silver market, the key metric is not total nominal inventory, but registered inventory, the quantity of silver that has been formally registered and is ready for delivery against contracts. Public data from COMEX show a clear multi-year trend. Registered inventory has declined sharply and persistently, particularly since 2020. This carries structural significance because registered inventory represents the last buffer that ensures the viability of the derivatives market. A clear distinction must be made. Silver in storage does not necessarily mean silver that can be delivered. Eligible inventory can exist under many forms of ownership and is not required to be made available for delivery. When registered inventory contracts, the delivery system becomes far more sensitive to demand shocks, even small ones. It takes only a modest percentage of contracts requesting physical delivery for the pressure to become sufficient to strain the entire mechanism. At the same time, data from international vaulting centers show a similar phenomenon. In London, one of the most important physical trading hubs of the global silver market, vault withdrawals have increased markedly during periods of stress. Reports from the London Bullion Market Association reflect a clear reality. Silver is leaving the storage system at a pace faster than it can be replenished in the short term. From a monetary analysis perspective, this is a signal that cannot be ignored. Derivatives markets can expand trading volumes almost without limit, but physical markets cannot. Silver must be mined, refined, and transported, all of which are constrained by physical realities and time. When deliverable inventories fall below a certain threshold, the primary risk is no longer price volatility, but the ability to fulfill contracts. It is precisely at this point that the difference between a price correction and a structural fracture becomes evident. A healthy market can withstand large price swings, but a market lacking sufficient physical metal cannot withstand a wave of delivery demands. As registered inventory thins, every increase in physical delivery demand forces the system to rely more heavily on technical tools to buy time. This helps explain why, during periods of rapid price increases, the system's response does not come from silver mines or refiners, but from trading rules and margin requirements. These are the fastest ways to relieve delivery pressure without requiring additional metal. In summary, Part 6 highlights a critical point. The recent price decline did not occur in a market flush with physical supply, but in a system where deliverable silver is being constrained. When the liquidity event is viewed alongside the inventory reality, the divergence between the paper market and its underlying physical foundation becomes clear. At this stage, if one looks only at quoted exchange prices, many may conclude that the silver market has cooled off. But for a monetary analyst, the more important question is whether that price still represents the ability to buy silver in the real world. The answer lies in physical premiums. In normally functioning commodity markets, the spread between spot prices and physical purchase prices is usually small, cyclical, and quick to compress as supply adjusts. But when premiums widen, persist, and fail to respond to price declines on exchanges, that is no longer noise. It is a structural signal. Reality is now revealing a clear paradox. Paper prices have fallen sharply, while the price required to obtain real silver has not declined accordingly. In many regions, buyers still have to pay a significant premium over the quoted price to receive physical metal. This highlights a crucial point. Exchange prices reflect the liquidity of contracts, not the actual availability of silver. From a mechanical standpoint, this is entirely logical. Paper prices are formed through leverage trading, where the majority of positions are settled in cash. Physical prices, by contrast, are determined by actual delivery capability, where each ounce must exist, be transported, and be handed over. When these two worlds operate under different constraints, their separation becomes only a matter of time. From a systems analysis perspective, this is the moment when the price discovery process begins to fail. When buyers cannot access the commodity at the published price, that price no longer serves as a reliable signal. It becomes a reference figure for the paper market, rather than a measure of real economic value. What is notable is that this phenomenon does not stem from a short-term speculative frenzy, but from defensive accumulation behavior. When institutions and individuals prioritize holding physical metal rather than contracts, premiums no longer compress in response to price declines, but instead reflect a declining confidence in the system's ability to deliver. It is precisely at this point that the concept of two prices begins to take shape. One price exists on trading screens, and another exists within the physical supply chain. Commodity history shows that when these two prices coexist for a sufficiently long period, the market is forced to restructure, either by pushing paper prices closer to physical reality or by allowing the paper market to gradually lose its role as the price-setting mechanism. Therefore, this section does not assert that the paper market will collapse immediately, but rather points to a fundamental issue. When physical premiums become the norm instead of the exception, quoted prices have begun to lose their pricing function. To understand why this physical pressure is not merely cyclical but also tied to structural changes in global supply, we need to broaden our perspective beyond Western markets and examine China's role in the global silver supply chain, which will be analyzed next. To understand why physical pressure in the silver market is not merely cyclical, we must widen our view to the global supply chain. Here, China plays a role that cannot be ignored, not only as a major consumer, but also as a central hub for refining and transshipment in the global silver market. In the recent period, China has reclassified silver into the category of dual-use materials, meaning it serves both civilian purposes and strategic functions. This classification is not merely an administrative label. In China's policy precedent, dual-use status is typically accompanied by stricter export controls, licensing restrictions, and prioritization of supply for domestic needs. Relevant policy announcements have been issued through the Ministry of Commerce of the People's Republic of China, reflecting state-level regulatory direction. The impact of this change is structural, not a short-term reaction. China currently processes and refines a significant share of global silver, acting as a bridge between raw extraction in other regions and industrial demand across Asia and Europe. When this flow is governed by licensing controls, the market can no longer adjust quickly through price alone as it once did. Supply becomes less elastic, particularly in the short term. From a monetary commodity analysis perspective, this represents a critical inflection point. When an essential material is placed on a strategic list, the priority shifts away from maximizing circulation toward optimizing supply chain security. This is especially true for silver, a metal central to renewable energy, high-power electronics, and data infrastructure. In other words, silver is increasingly being viewed not merely as a precious metal, but as a strategic input. What is the direct consequence? Physical premiums in Asian markets tend to widen and persist, regardless of paper price fluctuations in Western markets. When companies must compete to secure stable supply, exchange-quoted prices gradually lose their coordinating role. The market moves toward pricing based on access, not on reference contracts. The important point is this: this is not a speculative decision, but a policy decision. And policy, once implemented, rarely reverses quickly. That makes current supply pressure difficult to relieve through short-term price declines. Prices may be forced lower in the paper market, but the physical supply chain does not expand accordingly. When this picture is placed alongside thin inventories and prolonged premium expansion, one conclusion becomes clear. The silver market is simultaneously facing two tightening forces, one from transaction structure and one from supply structure. One force can drive short-term price volatility, the other shapes the long-term trajectory. Therefore, the question is no longer whether China affects silver prices, but rather, when a major supply hub changes the rules of the game, how will the global paper market adapt? When a market is simultaneously under pressure from leverage, thin inventories, persistent physical premiums, and structural changes in supply, the question is no longer where prices will go over the next few sessions, but how the system will adjust itself in order to continue operating. For the current silver market, there are three structurally plausible scenarios. Scenario 1: orderly repricing. In this scenario, the paper market accepts physical reality by allowing nominal prices to rise in order to rebalance supply and demand and compress premiums. This occurs only when balance sheet risk on the short side has been sufficiently alleviated or when technical tools, such as margin requirements, are no longer effective at suppressing pressure. This is the healthiest scenario for the system, as it restores the price discovery function. However, it requires one side to accept significant nominal losses, something history shows is not easy to achieve quickly. Scenario 2: a permanent divorce between paper and physical. Here, the paper market continues to exist, but loses its guiding role. Exchange prices keep fluctuating according to contract liquidity, while physical prices are formed independently within the supply chain, reflecting access and allocation priorities. Premiums no longer compress after price declines, they become a normal condition. This scenario has a high probability when confidence in delivery weakens, but not enough to cause a breakdown, and the system chooses to live with two prices. Scenario 3. Delivery failure, force majeure. This is the most extreme scenario, in which demand for physical delivery exceeds the capacity of registered inventory, forcing the system to settle contracts in cash rather than deliver metal. When this occurs, paper prices lose all legitimacy as a market benchmark. History shows that such periods do not last long, because markets are forced into deep restructuring, either shifting toward physical-based pricing or sharply reducing the scale of derivatives trading. The key point is this: these three scenarios are not mutually exclusive over time. The market may pass through the second scenario before being pushed toward the first or the third. But regardless of the path taken, the common denominator is the weakening of a pricing mechanism based entirely on leveraged contracts when it is no longer fully backed by physical metal. From the perspective of a monetary analyst, the recent price drop is not a signal that the story has ended, but a signal that the system is under pressure to adapt. Technical tools can buy time, but they cannot create metal. As physical pressure continues to build, the market will be forced to choose one of these three paths sooner or later. And it is precisely at this point that the final question becomes clear: how should investors interpret these signals, and what truly matters in a market undergoing structural change? After peeling back each layer of data, from price movements, margin mechanisms, position structures, historical precedents, and physical inventories to changes in the global supply chain, a systemic conclusion gradually becomes clear. The recent drop in silver prices is not merely a routine market correction, but the reaction of a mechanism under stress. Markets do not have a problem when prices rise. Markets encounter problems only when the underlying structure is no longer flexible enough to absorb that change. When this happens, technical tools are deployed to buy time, tightening leverage, adjusting rules, reallocating risk. At that point, price ceases to be a signal of supply and demand and instead becomes an instrument for stabilizing the system. What matters is correctly identifying the nature of risk. The greatest risk does not lie in sharp short-term price volatility, but in the erosion of the price discovery process. When investors no longer believe that quoted prices reflect real purchasing ability, confidence in the paper market erodes, and when confidence weakens, liquidity survives only through technical compulsion. From a monetary perspective, this is a familiar signal. Any system that requires an increasing number of administrative measures to maintain order is approaching a point of restructuring. The silver market today is at that stage, not collapsed, but no longer operating purely on trust. Mechanism has begun to replace signal. Therefore, instead of asking, where will silver prices go next, the more appropriate question is, which phase of a pricing mechanism's life cycle are we witnessing? If history is a guide, phases like this rarely end with a return to the old state, but with a new form of adaptation, whether through repricing, market segmentation, or a reduction in the role of leverage. For the serious observer, the greatest value of the current phase lies not in forecasting, but in understanding structure. When structure is understood, volatility no longer obscures, it becomes data. And in an environment where mechanisms are more exposed than ever, the ability to read that data correctly matters more than any short-term prediction. The silver market is not broken in a single day, but it is sending clear signals that the way it operates in the future will no longer resemble the past. For those who are attentive and patient, this is not the end of the story, but a critical transition point in the pricing system.